After 6 decades of running Berkshire Hathaway, Warren Buffett is retiring. Now, Warren Buffett invested in his first stock at 11 years old. He's currently 95, which means that he's been investing for 84 years, longer than most people have been alive. Now, he first became a CEO in 1956 when he started Buffett Partnership Limited, which means that he's been a CEO for 69 years. Today, the average age of a CEO in America is 57 years old. So Warren Buffett has been a CEO longer than most current CEOs have even been alive. Now, he took controlling interest in Berkshire Hathaway in 1965, so that was 60 years ago this year. And he has finally announced that some point this year he will be retiring. He became a millionaire at the age of 30. He became a billionaire at the age of 55, and he became the richest man in the world at the age of 78. It is no surprise Warren Buffett is considered one of, if not the greatest investor of all time. And there is no shortage of wisdom that he has shared about making money, investing, and life. And so today we are going to look at the top 15 lessons that Warren Buffett has shared that will make you more money and make you more successful. Quote number 1 from Warren Buffett is, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, the more you study the best traders and investors throughout history, the more you will realize that this is everybody's top rule. Never lose money. Risk mitigation is the most important thing when investing or trading. There are only 4 possible outcomes when you make an investment. You either make a lot of money, or you make a little bit of money, or you lose a lot of money, or you lose a little bit of money. Over the average investor's year, you will have small wins and small losses that net each other out. But the average investor, or the bad investor, will get scared that their small wins are going to get erased and turn into losses, so they will sell those early, which means that they don't ever have big wins. But then those small losses, they hope they'll come back up to break even, so they hold on to them, and those small losses turn in to big losses, which means overall, the average investor will have large losses driving the overall performance of the account. This is why rule number 1 of never losing money is so important, because if the only thing you ever do in trading or investing is always take a small loss, fall in love with small losses, make sure you always take those small losses, because if you do, they can never turn into big losses. That means that any big wins will drive the performance of your account. And if that's the only thing you take away from this video, I'll feel like I've done my job in communicating the most important rule that you can apply to investing, which is never lose money. All right, quote number 2, be fearful when others are greedy and greedy when others are fearful. Now, this is a very well-known quote by Warren Buffett. However, it is a lot easier said than done, because when most other people are feeling fearful or greedy about an asset class or an investment, so are you most of the time, which means that you are not easily able to recognize when you should be getting out of something or getting into something, because you are feeling the same emotions driving the behavior that is causing everybody else to panic or rush into a bubble. I've identified a few things you can watch out for with your own eyes and in your own life to tell whether or not you are operating out of fear or greed. One of them is the dentist test, or the taxi driver test, or the Uber driver test, or the aunts and uncles test. It doesn't really matter who, you just notice this, that when there's somebody in an unrelated field, somebody who is not a professional investor, doesn't really watch the stock market, doesn't really pay attention, and suddenly they are interested in a specific asset class. They are asking you questions, or maybe they have already gotten in and they are making wild amounts of money in an area that they don't understand and they have no business making money in. This is very common in retrospect. You look at things like NFTs and crypto bubbles, meme stocks, and I bet you if you think about it, you had a family member, you had an aunt or an uncle, you were sitting there with an Uber driver, you were at the dentist and you were hearing people talk about, man, I'm getting so rich from this. I'm going to be able to quit doing this soon. Or they're asking you, hey, I'm thinking about getting into this. Do you know anything about it? That is a red flag that euphoria and greed have taken over, and what you are witnessing is a bubble that is just about to collapse. You can also flip this around, and when the average person is losing a ton of money in a particular asset class, selling at big losses, usually that's a sign that fear has set in and you're near a bottom. Now, it might not always be possible to notice this from other people because you might be participating yourself and having that fear or that greed override your decision making. So one thing that I've noticed that has helped me identify fear or euphoria is my willingness or my eagerness to go in and check on my accounts. If I find myself throughout the day checking on my account multiple times per hour even, or multiple times even per minute, because I am so excited about all of the green, about how much money I'm making. You start thinking about what you're gonna spend the money on. You start looking at how much money you're making, calculating that out for your annual return, projecting that into the future and saying, man, by this time I'm gonna be worth this much. That is a red flag that euphoria has set in. And if it happened to you, it's probably happened to everybody else in that asset as well. And there's a good chance that you're probably at the top. On the flip side, if you do not want to check on your accounts, you don't want to look at your portfolio, you don't want to see all the red, you have the knot in your stomach when you think about it, you are just dreading opening it up and seeing what it's currently worth, that is fear. And probably 8 times out of 10, that's marking close to a bottom. So be fearful when others are greedy and greedy when others are fearful, even if you're feeling those same emotions yourself. Next lesson, the power of compound interest is such that if you start early, even with small amounts, you can build substantial wealth. There's an old proverb that says, do not despise the day of small beginnings, or do not underestimate the day of small beginnings. In other words, things that start off small, if you continue and persistently move them forward, they will snowball and grow, and given enough time, grow wildly. At the beginning of the video, I talked about all the money that Warren Buffett made by what age, but you can see from this table how insane that growth really is. Remember, he started investing at 11 years old, which meant that by the time he became a millionaire at 30, he had already been investing for almost 20 years. Most people today don't even start investing until their 30s. Given the same timeline, that means the average person today starting investing, let's say at age 30, would be on track to become a millionaire by around age 50. That tracks. The only difference with Warren Buffett is that he got started so much earlier. It meant he was able to hit 10 million at 37. It meant he was able to become a billionaire at 55. It meant he was able to become the richest man in the world at 78. And today at 95, he has a net worth of $161 billion. Now, are most people going to have the investing track record and the returns that Warren Buffett has? No, but most people are also not trying to become literally the richest person in the world. And even having a fraction of the percentage returns that Warren Buffett has would make most people extremely and happily wealthy. And you can simply get that from time. The earlier you start, and the more consistently you invest along the way, means eventually you will get there. Do not despise or look down upon the small days, the early beginnings, because it is the time that matters the most. Those first couple of years will feel completely useless, but they are not. They are seeds that will turn into trees, that will turn into orchards, and given enough time will feed your family for generations. Next quote, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Now, this comes in contrast to some of the other wisdom that people are more familiar with Warren Buffett talking about, but I like to focus on this one first because it shows the dichotomy between creating wealth and preserving wealth. Creating wealth requires concentration. If diversification prevents you from having large losses, it also prevents you from having large gains, which means that when you see an opportunity come along in your area of expertise, that you know and you understand. There is no wisdom in allocating just a tiny bit. In situations like that, where you see a good deal and you know it's a good deal, you've managed risk as effectively as you can, the most logical logical thing to do is to invest substantially. Don't risk ruin. Never bet the empire just for a pot of gold. But if you want to build substantial wealth, there will be times where you have to concentrate and you have to take substantial risks. And then once you've created wealth, then you can worry about preserving it. Next quote. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Now, again, this can be taken both ways. This is talking about the exact same thing we were talking about in the last lesson. Diversification there is to preserve your wealth. Berkshire Hathaway has acquired over 60 separate companies over different industries. And yes, most of the gains in Berkshire Hathaway over the last couple of years have come from Apple, just one position. But even somebody like Warren Buffett, who really understands business and buying businesses at discount and how to get value, he still diversifies away his ignorance, which means it's probably a good idea for us to do so as well. Next quote, do not save what is left after spending, but spend what is left after saving. Now, Warren Buffett is infamous for living below his means. Yes, he's got a nice house, but it is nowhere near the level of house that he could have being as wealthy as he is. He eats at McDonald's every day. He just doesn't live a lavish lifestyle at all, even though he absolutely could without even making a dent on his fortune. Now, some people will tell you if you want the motivation to push you forward to make more money, you should stretch yourself thin. You should buy the car that you don't need so that you have to come up with a way to afford it. You should live the lifestyle that you aspire to so that you get your mindset in the right place to start making that money and convince yourself that you can do it. This is short-sighted, ineffective, and an extremely stressful way of life. You have far less risk if you simply live below your means. I'm not saying give up your ambition. Still have the goals, still have the drive, still let that desire for more and accomplishing things and hitting certain milestones drive you forward. Just don't live like you're already there. The peace that you will get from that will allow you to focus all of your energy on productive activities, actually making more money. I can promise you, because I've lived this firsthand, when you overextend yourself and spend up to your means or sometimes even beyond it, the stress from that makes it extremely difficult to focus on doing the things that are correct that will make you more money. Constant worry about what if I don't make this? What'll happen if I can't pay for this? It's just not worth it. Nobody is watching you. Nobody is impressed by you. Nobody is thinking about you. It is far better to live below your means. You have a huge buffer, a huge safety net that you can use to invest, to grow, to make more money, and it'll definitely be worth it in the long run. Next quote, if you're in the luckiest 1% of humanity, you owe it to the rest of humanity to think about the other 99%. Now, this is something that gets political. I don't want to make it political. Obviously, I know Warren Buffett has a different set of political beliefs than I do, and if you've followed my channel for any length of time, you know this as well. But I do think, voluntarily speaking, that if you have the means to do so, then you have a responsibility to help people out who need it. I don't think it should be done involuntarily. I don't think it should be done through the government or through taxes because it doesn't actually work. They just take all the money themselves, which is why places that spend the most money on trying to fix the homeless problem just end up with more and more homeless people. But I do think that it's very interesting that the people who are the richest, and I'm not just talking about like the top 10 richest people in the world, I'm talking about millionaires, multimillionaires, usually, statistically speaking, they're the most generous people. Now you might say, well, it's easy to be generous when you have the money to do so. And fine, if you don't have the money, I'm not actually talking to you. But I don't find anything as satisfying to do with money as giving generously, giving huge tips at dinner, giving money to homeless shelters, food pantries, halfway houses. It's a rush. It's almost thrilling. It is by far the most satisfying thing to do with wealth you have created. And if you want to become wealthy, usually it's a good idea to do the things that the wealthy people do. Part of this is giving generously. It changes your mindset into an abundance mindset. You're there to give. You're not on this planet to take. And living like that and acting like that is one that will most of the time make you more successful. Okay, the next lesson, I don't actually have a direct quote, but this is a story from one time when he was giving a lecture and he told the students in the class to look around at their classmates and he said, if you could invest in one of your classmates and you would get 10% of their annual earnings for life, who would you choose? and then write down why. What are the things about that person that you see as being a good investment for the long term? It's probably not somebody who parties a lot. It's probably not somebody who wastes their money all the time, who has bad budgeting. Probably not somebody who's already in a ton of debt. Probably somebody with very good characteristics like leadership qualities, who is honest, who's responsible. It's probably not the person who just gets the best grades. There are certain qualities that you will be able to easily recognize in somebody that you have said, yep, that's who I would pick to get 10% of their earnings for life. Then he said, do the exact opposite. He said, pick somebody in this room that you're gonna have to short, which means that you are going to have to pay 10% of their annual income for the rest of their life. So you're trying to pick somebody who is gonna make the absolute least amount of money possible for their whole life because you're gonna owe 10% of that. Once you figure out that person, make another list of all the characteristics. What are the things about this person that make me think that they are going to be wildly unsuccessful for their entire life? They're probably very irresponsible. They're probably not very honest. They lie a lot. They don't follow through on their word. Maybe they have drug problems. He said, you come up with this list, you look at those characteristics and start implementing the characteristics in your own life of the person that you'd want to invest in, and start actively getting rid of the habits of the person that you'd want to short. If these are the things that are very apparent that will make you unsuccessful, these are the things that will make you successful, start replacing these things if you are, if you have any of these habits, and start replacing them with the good ones. I think this is a genius exercise because a lot of times it's hard to spot in ourselves the things that are good that we should keep doing that are making us successful, and things that are bad that we should stop doing that are making us less successful. And if we are able to pull ourselves out of our own body, out of our own mind, and identify those things in other people, it can be very easy then to turn that back around on ourselves. Okay, next quote. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And there's a second quote along with this lesson. He says, if you wouldn't own a stock for 10 years, don't buy it for 10 minutes. It might seem like on the surface that this is something that can only apply to investors, long-term investors, not even like active investors or swing traders or even short-term traders like day traders. But really what this is getting to is the heart behind it, which is I have a strong conviction that this company is going to do either really well or it's going to do really poorly. But sometimes, even though you have that strong conviction, you think you might see a window of opportunity where the opposite might happen. So personally, there are a few companies that I really, really dislike. One of them is Coinbase. I will never use Coinbase. I will never invest in Coinbase. I despise the company and I will never touch it with a 10-foot pole. That being said, there have been a few times over the last couple of years where I have looked at their stock chart. I have looked at the news. I've looked at what's been happening in the crypto market. I've been looking at what's happening with their fundamentals. There have been a few opportunities where I thought to myself, I think that their stock might actually increase over the short term. But guess what? I stuck to my guns, followed Warren Buffett's advice. If you wouldn't hold it for 10 years, and I definitely wouldn't hold Coinbase for 10 years, then don't touch it for 10 minutes. And so far, every single time where I would have tried to get in just for the short term, I would have actually lost money if I would have acted on it. Now, on the flip side, with his other quote, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. There have also been a few opportunities where I've looked at other stocks, other companies, and I've thought to myself, this is a fantastic company. I know they're probably going to do super well, but they've already been growing so fast, I think maybe I could wait for a pullback. One example is Netflix. I was thinking about buying it down in the $700 range, something like that. And I thought, nah, I'll wait for a pullback. Another stock I was looking at was Spotify around the $400, $300 range. I thought it was overextended and I would wait for a pullback. Even though I knew these are fantastic companies, they have huge loyal followings, great economic moats, fantastic business models. They're growing like crazy, but I just thought, I could probably get it for cheaper. That's dumb. If you see a company that's a wonderful company, it's better to buy it for a fair price than trying to scrape the bottom of the barrel and trying to pick up other companies that you think might be at great prices, but they're just not as good of companies. Go for quality every time. Next quote, price is what you pay, value is what you get. As a new investor, this one is a little bit hard to get used to looking at things this way, but you make money when you purchase an asset, not when you sell it. In other words, if you purchase it correctly, you've purchased it at a price that is below its intrinsic value. You got it for less than it is actually worth. And now all you have to do is sit back and wait for all the other market participants to realize that it is mispriced. Once the market prices it correctly, then you have realized the gain, but you really made the money when you made the purchase. And if you don't purchase it correctly, in other words, you pay too much for it, then likely you are not going to be able to sell it for more than what you paid because you paid for it what it's actually worth. Now, this doesn't just apply to investing. This actually applies to other areas of life and making money as well. All exchanges in life are actually like this. Price is what you pay, value is what you get. So when you go to work, what you are paying is time and what you are getting is dollars. You pay labor, you get skills. Value creation in life and making more money is all about doing as many of those exchanges as possible, paying something that you want less for something that you get in return you want more. Next quote, risk comes from not knowing what you're doing. In other words, the standard traditional investing advice that volatility is risk is wrong. Volatility does not equal risk. Volatility is just how much the asset price might move randomly. That's not risk. The definition of risk is what is the worst case scenario? What is the worst that could happen? With most companies, worst case scenario is it goes bankrupt. This is the idea of the margin of safety, because if you buy a business that is, let's say, at book value, then even if the company goes bankrupt, they liquidate all their assets and they return all that money to shareholders for the liquidation of everything that the company owns. You get back what you paid for the shares. So the worst that can happen is usually not you getting $0 back for your shares, because usually there's something left over. The company gets acquired, the company goes bankrupt and sells everything. There's a return of capital to shareholders. So you have to be able to look underneath the hood to see what's the worst that could happen, which is why Warren Buffett says risk comes from not knowing what you're doing. Because if you don't know what the worst case scenario is, then you have no idea how much risk you are taking on with the investment. Dumb idea. Don't do that. Next quote, there's always a new deal to be done. This is probably one of the things that drives more stupid investing decisions than any other flawed mindset. People thinking, if I don't get in on this, then I'll never have a chance to make money again. This is the last time this asset class is going to be this price. This is the last time this investment's going to be worth this much. This is the last time we're going to get I'm not going to have a chance to do this again. It's just not true. There will never, ever, ever, ever be an end of the opportunities to make money investing and trading. It will not happen. It is inherent to humans being alive. And so until the day that there are no more humans alive in the entire universe, in which case you won't actually care, there will not be an end to investing opportunities, which means if you don't have a safe way to participate in the opportunity that's in front of you, you don't have the cash, you don't have the income, your debt, whatever your situation is, if you don't have a safe way to participate, you're not missing out. There's gonna be another opportunity. Don't risk the empire for a pot of gold. There's always another long, there's always another short, there's always another bear market, there's always another bull market. There is never such a thing as missing out. And pretty much every time you make an investment decision based on fear of missing out on that opportunity, it's a bad investment, you're gonna lose money. Okay, next quote. The more you learn, the more you earn. Readers are leaders and leaders are readers. This is why anytime you see people who are in positions of power, who have lots of wealth, you talk to them about their story, you read their biography or their autobiography, you realize that at a young age or for most of their life, they were readers. They read as many books as possible. It's because any outcome is a result of the actions that produce that outcome. That's self-evident. But the only way to do the correct actions is to know what actions to take in the first place. And the only way to know what actions you should take is to learn. And the best way to learn what actions you should take that will produce the outcomes that you want is to study the lives of the people who have gotten where you want to go. See what they have to say. Listen to their advice. You get this by reading. If you're not good at visually reading, you can listen to audiobooks. It's the same thing. And if you don't have long enough attention span to read an entire book on audiobook, listen to podcasts. And if even that's too hard for you, watch YouTube videos. The medium doesn't matter. The point is, learning increases earning. Whatever medium you have to do it through is fine. Just do it. And the last quote of the day, the best way to make money is to provide something of value to others. Now, I'm gonna go one step farther. That's actually the only way to make money, unless you are a thief, unless you're stealing, taking money from somebody by force. The only way that you can make money is by giving somebody else something that they want more than the money they are giving you in return. And if somebody else is in a situation where they give something up that they want less, and they get something in return that they want more, then you have provided them value. So the only way to make money is to provide value. When this clicks, you realize the more you give to the world, the more you make. Creating wealth for other people is the way that you create wealth for yourself. In a very real way, your net worth is a measure of the wealth you have created for other people. Literally. Don't be ashamed of it. It is not a bad thing. Wealth is a good thing. It is not even a morally neutral thing. Wealth is a morally good thing, intrinsically. Again, unless you've stolen it, you've taken something from somebody else by force. Not talking about that here. The only way to grow your net worth, to increase your wealth, is to give somebody else something that they wanted more than what they gave you in return. And to the extent that you do that and you produce that wealth for others more than you consume wealth from others, you grow your net worth. That is a measure of what you have created for others, of how much better off you've made the world. Don't be ashamed of it. Don't live in secrecy. Let that fuel you. Let that drive you to go out and make the world a better place, because that is actually what you are doing. As always, thank you so much for watching. Have a great day.